Brad Muniz, a partner at Sobel & Company. I would like to welcome you to Sobel Insights. Sobel Insights is a weekly series that provides some brief information on various topics. Our goal is to keep these sessions to 15 minutes. At this time, we do not offer CPE. If you have any ideas for topics or speakers, please feel free to reach out to me. Our topic today is income from creative sources, and the speaker today is Gregg Abella, Chief Executive Officer of Investment Partners Asset Management. And before we dive into the creative sources, what are some of the traditional income-oriented areas that investors tend to utilize?
First of all, Brad, thank you for inviting me to speak today. I'm really looking forward to this topic. It's timely. Very quickly, before I get into your question, just want to give a quick disclaimer that I'm not making any specific recommendations to anybody. What I discuss on here might be of a high risk nature for some clients or some potential investors out there. Past performance is not a guarantee of future results. Investing involves risk. I think you can appreciate.
Absolutely. Talk with somebody and let them look at your situation before you start jumping into anything. Precisely.
So having said that, traditional sources of income for investors have been corporate investment grade bonds, as an example, of all sorts of durations, short duration, intermediate, long term, government bonds, treasuries, mortgage-backed securities, municipal bonds, and dividend-paying stocks. And if you go back traditionally to how an asset allocation might have worked for somebody looking for income, it probably would have held those four sub-asset classes in a typical portfolio.
Oh, so
flash forward.
Yeah. Go ahead. I'm sorry. Go ahead.
No, but to flash forward to now, where we're in an interest rate environment that is so upside down. To complement those traditional strategies, if you have a client that has a specific income need over a long period of time, it's very hard to use those traditional asset classes to get a sufficient rate of income that can keep the lights on. So, I mean, is there specific ways that people generally try and complement? I know that because I've dealt with you and I've dealt with other financial advisors, and diversification, hedging, and I'm not trying to put you into a box, especially with your disclaimer you issued before, because nobody should make a decision unless they talk with somebody. Are there generally ways that you try and level things off to complement one another? Like if you're going to be in bonds, then you should be specifically be and going something crazy type of thing, or no? Yeah. So great question. If you took a look at what, say, 30 years ago, how an asset allocation might work for an income-oriented investor and compare it to now, we have many more tools and access to a lot more data now than we ever have had before. So we can look at asset classes that might complement a traditional income portfolio and try to modulate the overall volatility of the account, but include other asset classes that maybe hadn't been considered before. And I'll just name a couple and maybe drill down into some of the more specific details of them and some of the risks and benefits of them. Just for an example, bank loan funds, for example, are funds of working capital lines. These have existed for a while, but they've become more popular in recent years because these are sort of like bonds, but they're the senior secured lines of credit for companies. So there are funds out there that are billions of dollars of just bank loans. So the benefit of that is that bank loans tend to be variable rate. So in a rising rate environment, you're getting paid more income. And assuming that the reason that rates are going up is that the economy is getting better, those bank loans tend to maintain their principal level. So you get the potential for some capital appreciation, and you get income and potential for more income if rates go up. Now, if the reason rates are going up is more cost push rather than demand pull, that could be, a shock to the economy, and that could actually impede bank loans. So you can't have just a portfolio of something like this. In fact, all the things I'm going to mention, you couldn't have a whole portfolio, shouldn't have a whole portfolio of just these strategies because of the risk involved. But they can complement an overall income portfolio and get a little bit more return with the potential for capital appreciation so that you can get income and address some of the concern of inflation from higher rates. It's interesting because everything you're saying, I'm listening, I'm hearing one word: diversification. And you're not saying, and I'm not even saying either, have 10% in each class, have 50%, 50-50. It all depends on everybody's particular situation.
Absolutely.
Yeah,
Absolutely right. And but some of the data we have now, those shows like, okay, so if you were to have X%, and again, it's client dependent, but if you were to have X% in this particular strategy, how do you offset that particular risk? So we have data on asset class correlation, one to the other, in a rising rate environment, in a bad market, in a recession. Doesn't mean it's foolproof, but not all, past is not prologue all the time, but these complementary strategies sometimes have somewhat predictable levels of how they perform in a number of different scenarios. So within some bands, you can have a sense of what sort of volatility you're adding to the portfolio by using some of these strategies. And I'll give you an example of another one. We use infrastructure related investments from time to time for clients. Those tend to be energy related assets. On the fossil fuel side, those tend to be like, funds of pipeline companies. They have high rates of income that they get from pushing fossil fuel through a pipeline. It's like a toll road. They get paid a certain amount of income. Due to the structure of the underlying investments, that income is usually passed on, and a high percentage of that cash flow is passed on as a dividend to the investors. So again, could you have a whole portfolio of that? It really shouldn't. But can you add something like that to a portfolio? Sure, potentially, depending on the client. On the renewable energy side, there are projects in wind, hydro, and solar that have an income orientation. So if you're not a fan of dirty energy, but you are a fan of renewable energy and you want access to this type of strategy, you can also get those types of investments. Those projects have very like a utility. They have very specific, or they have very somewhat predictable long-term levels of cash flow, and that cash flow tends to be passed along to the investor. It's a flavor enhancer. It's a way to get extra income, the potential for some capital appreciation, but also the potential for depreciation because you're taking equity risk. These are not like bonds. Another strategy is covered call writing or covered call funds. Those covered calls are where you give up basically the upside on your equity exposure in exchange for option premium. So you're giving up basically the opportunity cost of some of the upside on an equity portfolio, but you're getting compensated for that through an option, which you can then use as cash flow. So funds that do that, they write ongoing covered calls on a portfolio or an index. They take in that premium, they dividend it out. Again, it's a way to include something that is not maybe a more traditional form of cash flow for an income investor, but it can complement in an environment like this, where you're getting compensated next to nothing for your short duration income and very little going out 10, 15, 20 years on just the corporate investment grade.
Right. So it's very difficult for the average investor and even some high-end investors to figure out these, because you go look at the listing of investments that are available. They're not just putting this out there further. You and your team have to do research on this, and what might be an alternative investment today, tomorrow might not be, and what might be the risk today, tomorrow might not be. So you have to keep on top of this.
It's an ongoing study. And things change. We're constantly updating our models, updating our assumptions. Asset classes all the time, every quarter, every year, have new data as to their historical standard deviation of risk and historical return. So again, it's not a set it and forget it ever, really, with a portfolio. It's a matter of ongoing due diligence, looking at where the interest rate cycle is, where the economy is, and tweaking a portfolio to make sure you're trying to get an adequate level of cash flow for an income investor without taking undue risk.
So you mentioned the one word, and I happened to have lunch with a banker today about you two words. You said interest rates. Where do you think these rates are headed right now? I mean,
I would imagine on the short end of the curve, they probably have to go up. A ZIRP or zero rate interest rate policy was an effective tool in a pandemic, and we seem to be coming out of the other side of that. So we have to ask, is it appropriate to leave rates at zero for an extended period of time? And the Fed has already signaled on the long end of the curve, they're going to stop the bond buying to artificially keep rates low on the long end. So a third component of that is we're seeing inflation show up, not just in energy prices, but across the commodity spectrum, and potentially even in wages. So eventually, you can't leave rates at extremely low artificial levels and then have the economy pulling it in a different direction. You wind up with malinvestment. So my guess is you're going to see rates start to go back to pre-COVID levels slowly. Whether or not that will create a shock in terms of the fixed income market or the equity market remains to be seen. I hope the Fed doesn't have a misstep here, because we'll be right back into the soup. But I would have to imagine on the short end, we're going to be at markedly higher rates inside of a year, assuming the economy continues to chug along.
yeah, you see the Fed holding this pebble, and they're looking at the water, and they're saying, "I'm just going to throw it in there, and it's going to. How big can a ripple effect be?" And you never realize how much of a tsunami a pebble can create. And
Well,
go ahead.
It creates another problem, which is that we've printed $6 trillion just in COVID stimulus. So the overall debt level, publicly held debt for the country, is now in excess of $30 trillion. So let's just say that rates on the long end over time creep up. You're going to potentially, let's say the average maturity interest rate is, moves into the 2 or 3% range. You're talking about $900 billion of interest at that. It's, that's a massive amount of money. It far exceeds what we pay even in the defense budget. So where will it come from? And that's before we even consider some of the infrastructure plans that the government is talking about. And it's the chickens might come home to roost in a very unattractive way. So we have our work cut out for us trying to get growth investors and value investors into portfolios that we think can succeed in an environment where the interest rate cycle is going to potentially be an overhang as we come out of this. And look at where our country's debt level is and what interest rate is going to be prevailing.
I appreciate you not predicting, because I always hate when people try and predict, and then you say, you didn't say this, 3 months rates are going to go up, and then I talk to you 3 months in a day, and you're like, I don't know.
It's impossible to know. Let's just say I could make a very good argument that let's say we have some variant that comes out and we're right back into a shutdown mode. You could see the rates stay like this for a very long period of time, or COVID could just go into the ether in a year and the economy is revved up, in which case rates could be substantially higher. It's impossible to know.
And that's the important thing, going back to our original discussion that we were having. The intent of the topic was that there are alternative investments out there that people should be considering. And don't just listen to the one thought today, because these things will continue to change and evolve. And as you said before, the benefit today might not be the benefit tomorrow. The risk today might not be the risk tomorrow. So they need to continually talking with somebody like you who's in tune with these vehicles.
Yep, that's basically it in a nutshell.
Great. I appreciate the time. I want to thank everybody for listening. Greg, I want to thank you for presenting, and I look forward to having you presenting at future sessions or people from your organization.
Thanks so much, Brad.
Great.
Take care.